Imagine you're a real estate investor. Whether you're seasoned or just starting out, you dread hearing lenders say, "Your debt-to-income ratio is too high." This phrase feels like an invisible barrier halting your progress. You possess the drive, the deals, even the cash flow. Yet, suddenly, borrowing seems impossible. But what if I told you it's possible to purchase investment properties without touching that dreaded debt-to-income ratio, DTI? Not merely reducing it, not working around it, but completely bypassing it. And no, this isn't some dubious loophole. It involves strategic moves utilized by savvy investors to expand their portfolios while conventional buyers remain stuck in lending limbo. Let's dive deeper. Understanding debt-to-income ratio. Before we explore strategies, let's clarify what DTI is. The debt-to-income ratio reflects the percentage of your monthly income dedicated to debt repayments. Lenders use this number to gauge risk. A higher DTI presents you as risky, regardless of your cash flow strength. Most traditional lenders limit DTI to around 43%. For instance, if your income is $10,000 a month, your total monthly debts cannot exceed $4,300. This calculation encompasses mortgages, car loans, student loans, and credit cards. Here's the catch: investment property loans count against your DTI, even if that property is generating profit. This is why many investors find themselves stuck after acquiring just 2 to 4 properties. A hidden path: purchasing without affecting DTI. So how can you continue buying without triggering the DTI alarm? Employ non-DTI based financing strategies. These methods do not depend on your income or debt levels. Instead, they focus on the property itself, innovative deal structures, or using other people's funds. Let's examine the standout strategies. Strategy 1. Asset-based lending, DSCR loans. DSCR, debt service coverage ratio, loans can be transformative. Instead of scrutinizing your income, lenders focus on the property's income potential. Function: if the property earns enough to cover mortgage, taxes, insurance, and maintenance, you qualify. Typical requirement: a DSCR of 1.2 or greater, meaning the property earns 20% more than its expenses. Pros: no need for personal income verification. No DTI evaluation. Cons: potentially higher interest rates and down payments, often between 20 to 25%. This suits investors who have solid cash flow properties but limited personal income. Strategy 2. Seller financing. Seller financing is the original creative strategy. Essentially, the seller acts as the bank. Function: you negotiate directly with the seller for payments over time. Pros: flexible terms, no bank underwriting, no DTI check required. Cons: relies on the seller's willingness and your negotiation expertise. This method works best with motivated sellers. Think inherited properties, fatigued landlords, or off-market opportunities. Strategy 3. Subject to financing. This strategy is more advanced but offers immense power. Function: you assume the seller's existing mortgage, subject to original terms. The loan remains in their name while you control the property. Pros: no new loan, no DTI impact, often features low interest rates. Cons: legal complexities, risk involved if the seller defaults on other obligations. If executed properly, this can be a hidden gem, especially in high-interest environments with better existing loan terms. Strategy 4. Partnerships and syndications. Why go it alone when you can team up? Function: you collaborate with other investors. One offers the deal, another provides capital, while someone else handles credit. Pros: shared risk, no personal DTI implications, scalable approach. Cons: trust, clear agreements, and legal structures are necessary. This is the method large investors use for acquiring apartment buildings and commercial properties. Start small, like with a duplex, and grow from there. Strategy 5. Business credit and LLC lending. If you've formed an LLC for your investments, you can create business credit. Function: use your LLC to apply for credit lines, loans, even mortgages. Pros: keeps personal and business finances separate, eliminating personal DTI impact. Cons: building credit takes time, possibly requiring personal guarantees at the start. Your LLC can eventually operate independently, enabling you to purchase properties without influencing your personal credit. Strategy 6. Private money and hard money loans. These are non-bank lenders more interested in the deal than your financial situation. Private money. Loans from friends, family, or local investors. Hard money. Professional lenders focusing on real estate transactions. Pros. Quick, flexible options, no DTI checks involved. Cons. Higher interest rates, shorter loan terms, commonly used for flips. Strategy 7. Lease options and rent to own. Acquire control without immediate ownership. Function. Lease a property with a future purchase option. Pros. Minimal upfront cost, no mortgage, DTI remains unaffected. Cons. Not all sellers will agree, requires robust contracts. This approach lets you evaluate a property before committing, all while building equity as you wait. Strategy 8. Wholesaling. Technically, this means you are flipping contracts, not making purchases. Function. You discover a deal, secure a contract, and assign it to another buyer for a fee. Pros. No down payment required, no DTI impact, quick cash acquisition. Cons. Demands hustle, marketing skills, and negotiation prowess. Wholesaling is a brilliant way to gather capital for future deals, without ever needing to own property. Strategy 9. Equity partnerships. Instead of incurring debt, consider trading equity. Function. Offer a portion of the property in exchange for funding. Pros. No debt incurred, no DTI, shared profits. Cons. You relinquish a portion of profits and decision-making power. This suits high-potential projects where you need cash but wish to avoid loans. Strategy 10. BRRRR method: buy, rehab, rent, refinance, repeat. This approach is legendary, and here's the twist. Employ a DSCR refinance. Function. Acquire a property with cash or hard money, rehabilitate, rent, then refinance with a DSCR loan. Pros. Rapid equity growth, avoids DTI issues, scalable model. Cons. Requires initial capital and rehab expertise. This is how investors amass empires, rehabbing one property after another. Creating your action plan. Suppose you're facing the DTI barrier. Here's your way forward. 1. Assess your portfolio. Identify cash-flowing properties and those eligible for refinancing with DSCR. 2. Expand your network. Connect with private lenders, wholesalers, and sellers willing to explore creative deals. 3. Establish your LLC. Begin cultivating business credit and separating your finances completely. 4. Sharpen your pitch. Whether negotiating seller financing or partnerships, presenting deals effectively is crucial. 5. Stay compliant. Collaborate with attorneys and CPAs to ensure every deal is structured appropriately. Shift your mindset, from borrower to dealmaker. The largest transition isn't financial, but mental. Move away from thinking like a borrower. Embrace the mindset of a dealmaker. Banks deny? No problem. Seek a seller who agrees. Maxed out DTI? Fantastic. Use the property's income to your advantage. No initial funds? Great. Consider trading equity or wholesaling. You're not trapped. You're simply preparing for your next chapter. Final thoughts: the strategy over gimmick. Purchasing investment properties without impacting your DTI isn't a trick. It's a smarter investment strategy. This is how industry professionals scale efficiently. This is your pathway to escape the constraints of traditional lending and accumulate genuine wealth. So the next time someone claims, you can't acquire more properties, smile knowingly and say, "Just watch me." Imagine standing before a perplexed lender, their dismissal echoing in your ears as they question your ability to expand beyond that invisible debt ceiling. But as you shift your perspective, you realize that your journey is not solely about fighting the system, but about redefining your approach to property acquisition. With innovative strategies at your disposal, each deal becomes a stepping stone, allowing you to forge a new path in real estate that aligns with your ambitions and financial goals. You become not just a participant in the market, but a master of your financial destiny. Real estate investing can often feel like navigating a labyrinth, but understanding the potential lying within creative financing can illuminate your way. By harnessing the strategies outlined, you can catch opportunities that others miss, transforming barriers into pathways toward achieving your investment dreams. After all, every challenge presents the perfect opportunity for an innovative approach, encouraging you to expand, invest, and ultimately thrive in an ever-evolving market. Your journey doesn't end with comprehension, it's only the beginning. Picture yourself confidently engaging in multifaceted negotiations, leveraging unique financing options. You realize that each strategy offers distinct advantages, allowing you to customize your approach to fit your investment style and portfolio needs. As you continuously educate yourself on these alternative methods, you enhance your agility in the market, an ability to pivot and respond to shifting economic conditions. Embrace this transformative mindset, as it shapes you into a formidable force in real estate investing. This is how you pave the way not only for personal growth but also for building a legacy that will endure for generations. When you adopt these strategies, you not only navigate the complexities of the real estate market but also strengthen your financial foundation. Imagine tapping into asset-based lending, where lenders prioritize the cash flow of your properties over your personal income, allowing you to acquire more assets seamlessly. With seller financing, the power shifts into your hands, enabling you to negotiate terms that benefit both you and the seller while avoiding the strict scrutiny of traditional lenders.